We are talking wealth development strategies with opportunity zones. Um, Wealth development or building wealth with OZs is kind of the unofficial theme of this year's OZ Pitch Day or this iteration of OZ Pitch Day. We had our opening keynote fireside chat with Andy Higgins was all about building generational wealth with alts. And we've had some wealth topics sprinkled throughout some of the presentations today as well. Taylor was just speaking about Starpoint Properties and how their goal is to build generational wealth for their clients. Kirk, I wanted to actually start with you. There you are. You and I have been talking for some time. Kirk, we met I don't know, a year and a half back at a Novogradac event. And you mentioned something interesting to me, and I kind of want your thoughts on it to kind of get the ball rolling here. You seem to believe that QOFs are probably the most efficient, the tax efficient way to hold real estate, and it has the potential to be like a super Roth. Can you explain what you mean by that to kind of get the ball rolling on the conversation today?
Thank you, Jimmy. Happy to join you guys. Great to be here today. Really enjoying the presentation so far. And that's a great question. I've been beating the drum about how there's a more efficient way to utilize the Opportunity Zone Fund for the ultra wealthy. Our background is running family office for our ultra wealthy people, and I'm a tax lawyer and estate planning attorney by background, as well as managing the investments. And we utilize the Opportunity Zone funds for our family office clients at first, and then we've launched it for others when people heard me talk about this concept that you mentioned. The regulations allow for reinvesting of cash flow from transactions on interim transactions inside the fund. And most Opportunity Zone funds are sending the money back to the investors. But if you're an ultra wealthy family, you may not need the cash, and it might be more advantageous to take the money from the cash flow and cash out refi events, or even sale of a partial asset like a pad and excess land, and reinvest that into more and more Opportunity Zone assets, like you would the dividends inside a Roth IRA on the stocks that you hold in your Roth IRA. You're not taking the dividend checks and sending them to your checking account where they're going to be invested somewhere subject to tax. You reinvest them back inside the Roth IRA and keep them sheltered. The other way, it's very like a Roth IRA, is the long-term time frame. Everyone knows that 10 years is the bare minimum that is needed to get the tax benefits. But for a Roth IRA, you can cash out your Roth IRA after a bare minimum of 5 years and reaching age 59 and a half. But nobody cashes out their Roth IRAs at age 59 and a half with 5 years of ownership, because you can continue, unless you desperately need the cash, you can continue to increase tax-free growth inside the Roth IRA. Similarly, your Opportunity Zone Fund can continue to deliver massive tax benefits after the 10-year mark. And the logic that applies today, whether it's better to put your money into a tax efficient vehicle or in a taxable account, also applies 10 years from now, when you have the option to sell and remove it from a tax sheltered vehicle and put it back into a taxable account. And so our game plan is to try to find core assets that you would want to hold for a very long time in key markets, and then monetize them with a cash out refi rather than a liquidation, continue to benefit from the depreciation deductions, which are not subject to depreciation recapture. So you want to go as long as possible to maximize those benefits. I really feel like the Opportunity Zone Fund is maximized when you view it similar to a Roth IRA.
No, that's great. Great way to start the conversation today, Kirk. And by the way, gentlemen, forgive me, I forgot to introduce the three of you. So we were joining the panel today are Brad Malotsky, partner at Duane Morris, Jerry Ryson of Ryson and Associates, and Kirk Walton is managing partner at GPWM Funds. They are Opportunity Zone investment leaders that I've been following for quite some time. Brad and Jerry, do you have any comments or follow up on what Kirk just had to say?
I agree. I think that Kirk's point, as usual, as always, is spot on. The ability to generate money within the structure exists. The ability to utilize some other structuring relative to, if you're thinking about investment tax credits, can also be used to allow for cash flow to go to an investor and have the ITC shelter them and have depreciation shelter them for their normal cash flow that they would get that would be taxable. So it's a very, as some earlier have said, it's a very efficient way to invest, grow, sell. And you don't have to sell after 10 years in a day. You can, but you don't have to. So the ability to keep generating that cash flow and or retain it inside the vehicle provides for an interesting dynamic, in particular when if you're not so IRR driven as some of Kirk's clients will be. They're not paying attention to IRR as much. They're looking for long-term appreciation. So again, I totally agree.
And Jerry, let's bring you in here. What are your thoughts on how opportunity zones should be utilized in general to develop wealth? And if you have any other comments on what Brad and Kirk had to say, please let us hear it.
Sure. Well, Kirk and I have known each other for years now, and our first discussion on a group we were participating in, we had after the group, where we both got somewhat orgiastic about what you could do with the opportunity zone and investing and reinvesting forever. Frankly, you can reinvest beyond the term of the statute, which the IRS has said ends in 2047, which is somewhat controversial because the statute doesn't say that. In any event, I mean, you can cause a tax event in 2047 and continue on with a basis increase. Kirk does. I do, and I represent investment funds as opposed to having one, and I represent families and family offices, both in helping them place their qualified capital gains in enterprises like Kirk has, which is very consistent with my thinking, or their own self-directed opportunity zone vehicles, which can even be it can be more or less advantageous. Kirk runs a professionally organized and administered fund, but he has all the controls. A family office or a family may want to have more controls of their own. And frankly, sometime in the future, I may be going to Kirk and having selected of my self-directed family office QOFs merge into his funds. And that's a big play in this place. If they get tired of managing their own investments, you can merge into Kirk's fund. You can merge as currently a public real estate partnership QOF you can merge into and walk away with listed securities. There's just so much you can do with this. It's frankly inexcusable for any person or family of means not to be invested in QOF, and in particular, I believe, have their own self-directed Roth IRA on steroids type QOF.
Totally agree, Jerry. I'd say friends don't let friends pay tax on capital gains. It is an absolute atrocity when you see the money that is being wasted unnecessarily. When you look at the depreciation deductions, the ability to accelerate the depreciation deductions with cost segregation studies and qualified improvement properties, it's so much better than a 1031 exchange. It's so much better than just about any other type of vehicle. The government created an uneven playing field with the regulations, and it's true. Jerry and I, I knew Jerry as the regulations were coming out, and we got the final regs, and we're reading them right after they came out, and we're like, am I reading that right? It really is that way. Jerry's point about individual opportunity zone funds, that's our specialty. And lately, we've even partnered up with some families who have their own opportunity zone fund already and are looking for projects and have more cash than they have projects. And we've created a couple of unique solutions, I think, for that situation where we're able to allow existing QOFs with money access to our project and our oversight and tap into our pipeline and our expertise in that area, while at the same time maintaining control over other projects that they self-manage. We've created that kind of a hybrid and work very well, with that type of a structure, which I think is unique in the space.
Aren't you guys still surprised though? So everything I agree with what you just said, but when you think about, we're like 5 years into this thing, and we swim in this pond, so we talk to people all day kind of about this stuff. And, we're geeks when it comes to kind of what this whole thing is all about. But there's a bunch of very smart people that own businesses, that have capital gains, that buy and sell real estate, that still 5 years later still really don't know what we're talking about. I mean, and it is befuddling to me that, we have loud voices and we talk to a lot of people, and yet there's still a lot of people out there that really don't understand the very basics of what we're talking about. And, Kirk, to your point, friends are letting friends pay taxes. And so really, despite the fact that Jimmy and others have done an amazing job of being online and being out and about, there's still a lot of people that still don't know about this program. And, by the time they get in, it's almost like 2026 already. So it's really mystifying.
And
I had a client. Go ahead.
No, I feel bad for the CPA out there. There's got to be some CPA out there who hears about this and talks to a client, and they sold their business and they triggered a massive capital gain. Oh, you can do this opportunity zone fund. When did it happen? 7 months ago. Like that story is going to happen somewhere. Yeah. And I feel like word to the wise, to the tax professionals, the advisors, the CPAs, the estate planning attorneys, get in front of your clients and notify them about this opportunity long before they get into the transaction, because there's going to be somebody out there who's going to miss the boat, and it's going to be really tragic.
100%.
I had a client who actually decided not to invest because, it's not fair that I'm not getting the small step up in basis that is expired on my capital gains that I'm going to invest in the QOF. I mean, the fact of the matter is, I've given up trying to convince people.
Don't give up.
If they're too mentally deficient to understand, once I've gone through it with them once or twice, right? I did a podcast, the title of which was more than 90% of CPAs, transactional attorneys, wealth advisors, chief investment officers are committing malpractice by not thoroughly understanding the opportunity zone statute. They don't have to know the details of how to do it. There are plenty of people out there. On the other hand, I don't know how I could handle more work. So
there's only so much Jerry to go around.
I understand the complexity and why, something that's new and something that's complicated when you first look at it, that can be overwhelming to some people. When you're dealing with a transaction that involves a significant life event, the sale of the family business, for example, when you're dealing in 8-9 figure numbers, you can get deer in the headlights. You also have advisors who have their own self-interest, and it's really hard for the conventional investment advisor to make money off an opportunity zone investment. And so there's not really an incentive for most investment advisors to talk to their clients about that.
I find M&A lawyers who only have to mention it, and they can generate another $20,000 or $30,000 in legal fees, still don't mention it. Same with CPAs.
Keep that.
You're
keep
right.
that under your hat,
advisors, but to tell you the truth, the wealth. I mean, I don't know what to tell you guys, man. It's
Keep that transactional lawyer point under your hat. You don't need to tell anybody that. That's where others are running around and making hay.
Let me mention one other point that I think is often overlooked for the ultra wealthy, and that is how the Opportunity Zone Fund creates almost the perfect vehicle and asset class for long-term wealth generation, for a gift trust or a grantor trust, an intentionally defective grantor trust, where it's illiquid, which is advantageous when you're talking about assets that are going to the downline generations. It provides long-term growth. It continues to appreciate tax-free, even if the parent generation passes away. And the tax benefits, the tax bill, if it comes back, will reduce the parent's estate, but all the growth, all the appreciation, all the rent and income are going to escape estate tax, gift tax, and generation skipping transfer tax potentially, if set up right. And
it passes through probate at what you invested in it, not at the increased value.
It's an absolute game changer when you run the numbers for a long-term super Roth type strategy hold on an ultra wealthy family, setting it up in a grantor trust for the kids.
Kirk, the other thing I try to tell these clients is that there's there's no downside in setting it up. It's not very expensive to set these things up. If you don't know what you're going to invest in, we can give a runway of about 4 or 5 years before they have to figure out what to do with it. And meanwhile, that 10-year clock is ticking most of that time.
That's right. The 10-year clock starts when the cash goes into your Opportunity Zone fund, not when the Opportunity Zone fund puts money into the project or the QOZB. And that's important to remember, because if you are looking at a shorter term, there's nothing stopping you from selling at 10 years if that's the right time in the marketplace, or if that's the right time for your family to sell 1 or 2 or whatever. If that, whatever is the best interest of the client, you'll have the flexibility to do that at the 10-year mark if that makes sense. But you won't be on a train that's only going to go to 10 years and then stop. You'll have the flexibility to continue if that makes more sense. And who knows what the future brings. But
And
when
let
you
me
reinvest
mention-
cash flow into another project, let's say you start a project now, you could reinvest the cash flow from the cash out refi in 2 years, and that project you would only own 8 years. And
if you set
could
it
still
up
sell.
and you don't know exactly what you're going to do, the worst things happen is you've deferred taxation for 1, 2, 3 years out, and you can collapse it and pay your tax if you wish.
I had a client. I had a client whose 180-day clock was running out, and they had 40 million in gain, and they were thinking about doing about 25, 30 million in the fund and putting 10 or 15 somewhere else. And I said, look, let's just keep your window open. And so they dropped all 40 into the Opportunity Zone fund, and they just held it in cash, and that bought it bought them 9 months based on where they were in the calendar. And over those 9 months, they ended up keeping it all in. In fact, they've reinvested the cash flow from the projects that have come back. So it is important to recognize how you can, daisy chain the timelines, your 180-day from the gain event, and all the flexibility you get with that, from the March 15th, if it's a K1, to December 31st, if it's an installment sale, to, you can daisy chain that out. And then your QOF has between 6 months and a day, or a day less than a year, before it has to drop it. And then the QOZB has another 30 months to come up with a plan for how to spend it. So you can really stretch this out in a conservative fashion and dial the needle really conservatively. Or if you're more aggressive, you can dial the needle more aggressively. That's where the flexibility. I love this program, because Congress got out of the way and gave us something incredibly flexible, and that's a massive benefit to the investors.
Well, gentlemen, I wanted to step
Okay,
in here. We got a couple of questions in the chat, not following the conflict of interest topic here. Or Brad, I guess you mentioned you weren't following the top conflict of interest topic, but there was a question about, is there a conflict of interest for M&A attorneys and CPAs that investors should know about? I don't remember which one of you mentioned.
No, so that's what I was trying to allude to. I'm not following what the question was relative to the fact that an M&A lawyer would raise to his client or her client that there is a program for purposes of when you sell a company or when you merge and you have capital gain. There's no conflict there. Relative to depends on who the client is. Is it the individual or is it the company? Maybe that's what they're referring to. But I'm not seeing that as a gating issue vis-a-vis. What we're really talking about is, does an entity have gain that's eligible for purposes of OZ? If they do, to Jerry's original point, he was a little tongue in cheek, but it's real. It's almost malpractice relative to the amount of people that are not talking about this to their clients, so that their clients can prepare, think about it, reject it if they want, but give them the facts so that they can make an informed decision. There's not a lot of that conversation going on.
Let me say something about the deferral. People underestimate the value of the deferral. I have a client that is in California, had about $50 million in capital gains. And in California, the solar rooftop investing is very lucrative, but it's not got a lot of marketplace throughput. So we created QOF for him. And you can get a 1-for-1 tax credit almost, because you get the value of the project, 70% of which might be debt, right? So whenever he sees a project he wants to invest in, he just spits out some of his capital gains, incurs a tax event, applies the tax credit to it, and he has a free income stream at a very nice number. If he finds the deal in an Opportunity Zone, he'll leave it in the structure. If not, and again, you don't have any flexibility or opportunities if you haven't set this up.
Great point,
That's
Jerry.
right.
Hey,
So it's all about keeping that option on the table for the client. You don't have to advise them to do it, but so few people know about this. You need to at least get informed enough if you're in that space and mention it to them and put them in touch with any of us. You know, we're all passionate about it and care about the best interest of the client. That's the reason all of us are in this space.
wanted to see if we could zoom out for a second, cover maybe a more basic, broader point. What about asset classes, gentlemen? I'm curious your take. Which asset classes have the most potential for opportunity zones within the opportunity zone structure, given OZ's bent toward capital gains and appreciation?
I'll take a shot at and I'll twist the question a little bit, Jimmy. I
Go
think
for it.
that you're seeing a lot of deals in the multifamily space because it's relatively easy. It's pretty middle of the fairway, find good rents, find good returns in decent markets, and it's relatively easy to do. We're seeing a bunch of deals in warehouse as well. Similar, topics, similar deliverable, better cap rates for all intents and purposes, even despite Amazon's pullback, and in cold storage. So those three areas, warehouse, storage, and multifamily, are kind of the easy ones. Where I see, others are to our earlier conversation, people have still not focused on. I talk about this all the time with clients, and they hear me and they get it, but they don't really move there. It's any cash stream that's being delivered from a particular project has the potential to be OZ eligible and can take off. So think about a property. It doesn't have to be real estate, but think about like in a property, you've got all kinds of stuff going on. You've got painting and carpeting and HVAC maintenance and glass cleaning and landscaping and property management and leasing. Each one of those things has the ability to derive revenue. If we can create NOI revenue over a period of time, enter into like a non-cancelable contract in year 9 for 10 years, then you have something to sell. If you've got something to sell and you structured it the right way, that ability to create non-taxed sale proceeds is magic. And that's people really haven't gotten there yet. We've done some PropCo, OpCo deals where you're building the project and then you're putting an operation in, but they really haven't started to really think through yet, which will run out of time here. Those operating revenue streams, I think, that's where some magic is.
We're looking at classic car investment, whiskey investment.
Sure.
And we think we can get these structured. We're pretty far down the line on them. So asset classes are not just, as far as tangible asset classes goes, it's not just real estate. And everybody's missing the boat on operating companies. When we've got a whole process where you set up as an opportunity zone company, the founders can do that. And as you grow, you can switch to your operating company, be a corporation, and have 1202 investors on the venture side. So
that's why you don't see too many tech startups in the opportunity zone space. And that's my background as tech startups. You've got the qualified small business stock provisions. Section 1202 gives you 10 million per investor, tax-free gain, no geographic limitations, and only a 5-year hold. So that's, better, but you can actually double stack. So there's nothing wrong with doing both.
Right.
With respect to asset classes, I've been championing rehab over new construction for a long time. And that's because we have qualified improvement property on the books right now, which is eligible for bonus depreciation. It has nothing to do with the opportunity zone tax law per se, but it works really well together. Qualified improvement property is an extra deduction you can take for the cost to improve the interior space of an existing building that is treated for commercial purposes. And we have a lot of projects that fit this bill that'll be commercial in theory, because the test for whether it's commercial or not is 20% of the rents from commercial tenants. So we can have like our Reno project that I've talked about a few times. It has, a bunch of restaurants, retail, office on the ground floor, but then it's got almost 1,000 hotel rooms and 3 towers that we are converting to apartments. And, our play is about the apartments there, but it'll be classified as a commercial asset. Most of the expenses, we have a $200 million budget, about 65 million in cash, 140 million in construction debt. Most of those expenses are going to be eligible for bonus depreciation and QIP, which last year you could take 100% of the stuff we placed in service. Our Starbucks is open and things like that. We placed in service some of the space in 2022. we're able to take 100% of those improvement costs. And in 2023, we're able to take 80% as a bonus depreciation plus whatever the depreciation is on the leftover 20%. So it's an enormous advantage where we're able to generate passive losses on the K1s that flow out to the investors in excess of the cash going into the deal, the capital gain going into the deal. So especially for those investors selling a passive real estate asset, the Opportunity Zone Fund is even further juiced on steroids. It's insane.
Someone asked a question about whether they can invest outside their state. Let me mention something that we've done. So California, New York, Mississippi, can't remember the other ones that don't follow the Opportunity Zone program with regard to state law. We have made arrangements so that a party preparing to make a capital investment puts that investment in a pass-through partnership in Texas, let's say, and then invest in an Opportunity Zone fund through that entity. Now that entity will never get the gains, and so it'll never hit their California personal income tax. So you've made it work for a person. So yes, you can invest outside of your state, and if you're in California, you better.
I would just add to that, Jimmy, and Jerry, that to Kirk's point on just a reminder, most folks on the call probably know this, but as a reminder, the OZ benefit is stackable with other benefits. It's not one or the other. And so being able to juice a return, the OZ is awesome, but you can add to that historic tax credits if that's relevant. You can add to that new markets if that's relevant. We've started to play with and have worked through CPACE, so commercialized PACE, which is a whole other conversation as a lending source that's off-bill financing on your real estate taxes. Not available in every state, but 32 states have that. We talked a bit about, solar and the ability of solar or wind to use ITC, the investment tax credit that's federal, to offset some unused depreciation, to offset your current income. And then we've got kind of stuff that's in the Inflation Reduction Act that, again, irrespective of OZ, but it just juices OZ to sort of say, look, we're adaptively reusing and we're going to use 179D to deal with energy efficiency upgrades in a building, lights, plugs, HVAC, glass, and get $5 a square foot just for the fact that you're going to do it anyway. You're going to build to code or a little bit better. That stuff exists. You just need to marry it with the power of the OZ, and it just, supercharges it. It's not as good as the super Roth IRA analogy, but
when you can put all of them together in one wrapper, why not? Especially if you consider the ultra wealthy are going to own real estate as part of an asset class in their overall portfolio for years and years and years. It's a common asset class to have a significant slice allocated to. And then when you go to, Opportunity Zones cover 16% or something like that of the surface area of the country. They're literally everywhere in areas that you would want to invest anyway. So when you distill it to its core, this is the way to own the real estate you're going to already own anyway. And when you look at the disparity of the returns in a zone, out of the Opportunity Zone, you're going to own real estate anyway. I can find you a project that's in an Opportunity Zone comparable to any project you would otherwise own.
And by the way, once you've held that vehicle for 10 years, you can start flipping properties or whatnot. The holding period for the property becomes irrelevant. Everybody should have their own self-directed TOF. I mean, it's just ridiculous. And some of it can go into a commingled fund, whatever. But it's just, I don't know what to say.
All right, well, gentlemen, we've only got about 90 seconds left, so I'm going to give each of you 30 seconds. Try to stick to that. Best practices to develop wealth with Opportunity Zones. What's like the number one point or step that wealthy individuals, family offices should be taking with regards to building wealth with OZs? Brad, I'll start with you.
It's been mentioned before on the other panels, so if people were missing, solid developer that's done it before over and over and over again. Not the first rodeo, not the second, but that they know what the hell they're doing. They've done it before. They can show you kind of what they've done and where they've done it. And when problems come up, which they ultimately always will, they know how to handle it. It's not like, oh my God, the sky's falling, costs are going up and interest rates are going up. Well, no, duh, that stuff happens occasionally, throughout the life cycle of these projects. And so again, my one takeaway would be make sure you understand who you're investing with and make sure they've done this over and over and over again.
Jerry, how about you?
I would say two things. On Brad's point, don't forget you do your due diligence, which we do a lot of. I have my own investment platform, and I often work with independent due diligence firms as well. And as to a captive vehicle, remember, you don't have to just use qualified capital gains. You can loan yourself money. You can create a portfolio large enough so you can invest in many things outside of opportunity zones that don't qualify as opportunity zone assets. Build that portfolio as big as possible for as long as possible, and have the flexibility if you need to get out after 10 years, or get out with some. But don't just limit yourself to your capital gains.
And Kirk, we'll leave you with a final word.
2 points. One, friends don't let friends pay tax on capital gains. It is atrocious if you have a capital gain event and you don't seriously take a look at this. 2, the opportunity zone regulations are complicated. These are treacherous waters, and there are ways that people can slip up, and the consequences can be draconian. So you don't want to sail through these waters without an experienced guide. So those are my takeaways. Find somebody who really knows the space and is passionate about the space that can help you navigate through that. I love talking about this. I can't stop talking about it. Jerry's the same way. Bob's, just call one of us and pick our brains. We're happy to chat. We're all in that mindset of we want to help people avoid the capital gain. And even if you don't invest with us, I want to help people. And that's why I'm in the space. It just makes me sad to see dollars wasted when there's so much benefit to be had through the Opportunity Zone Fund.
Well, absolutely.
Terrific insights from all three of you today. Brad Molotsky, Jerry Ricin, Kirk Walton, thank you so much for participating today. Really appreciate your insights. This has been an incredible panel. Thank you so much.
Thanks,
you.
Jimmy.
Thanks, Jimmy. Thanks, guys.